deductions. I want to talk about some other recent developments that are applicable to this field of retirement account. Remember, I said that your clients can still make traditional IRA contributions regardless of their age. Now, remember, and this is pre-Secure Act, individuals who are at least age 70 and a half can make qualified charitable distributions from their IRAs, right? So before the Secure Act, that was a clean transaction. You are at least age 70 and a half today, then you can make a qualified charitable distribution from your IRA. And it's tax-free up to $100,000 as long as certain requirements were met, right? Clean transaction. But then comes the Secure Act, which says you can make contributions regardless of your age. So now you're going to have clients who are making contributions to traditional IRAs and then doing QCDs, qualified charitable distributions. Why is that important? Because if your client took a deduction for a traditional IRA contribution, then that affects the amount of a QCD that excluded from income. Now, the math can be easy if it's, say someone made a QCD in 2021 of $50,000 and made a deductible contribution of $5,000. Then that $5,000 is subtracted from the $50,000 and only $45,000 is excluded from income. But as we go from year to year, the tax professional is going to have to do an addition of, well, how many tax deductible contributions did you make in the year you reach age 70 and a half or later? And then how many qualified charitable distributions have you done? Not how many as in how often, but is in the dollar amount. Because now we're going to have to do some math, right? And so for those of us who don't like math, well, luckily there is accounting software that we can use for that. But the important thing is to remember that the QCD that your client takes might not be fully tax-free if your client made deductible contributions to traditional IRAs. And in my handout, I included some examples of how that works. Now, some recent developments